People have always talked about the next recession, and over the past months, plenty of billionaires and fund managers have been talking about a potential economic slowdown. One of these notable people is billionaire hedge fund manager Chamath Palihapitiya. He has been warning us about what the Fed's actions would cost. Back when the Fed printed too much money, things weren't looking good. Inflation was at an all-time high, the financial market skyrocketed, and speculations increased in alarming intensity. Indeed, the Federal Reserve plays a crucial role in the economy's well-being. The risk lies in the Fed's reaction to increasing prices. Multiple economists, fund managers, and retail investors are worried sick about this, and Chamath has expressed his opinion about it. He claims that there is a bigger problem than inflation that we should look out for. Hey, welcome to Stock Market Mate. In today's video, we'll talk about why Chamath Palihapitiya believes that we're entering an economic recession. Before we get into it, make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Chamath emphasizes that inflation isn't the only dictator of an economic recession. The Fed is adamant about cutting its balance sheet and increasing interest rates to counter inflation. Plenty of investors have said that inflation is not being transitory, but this may potentially be a self-inflicted prophecy. This, though, made the Federal Reserve overwhelmingly aggressive. Similar to the event in May 2020, the Fed may be overreacting once again. Chamath claims that inflation may actually become more transitory than expected, all because of the Fed's exaggeration. Another investor named Jeremy Grantham has been talking about a market crash for America's super bubble. He stated how the market has been affected by the pandemic, excessive money printing, unexpected inflation, and high interest rates. However, people are skeptical about Grantham's predictions. He did make a few concrete points in the past. The economy of the United States is currently in a vulnerable position from all angles. Chamath says that if the Fed overreacts, the whole country will suffer from an economic recession. The biggest determining factor that may result in a recession is the bifurcation, or simply the division in the global economy. If you think that interest rates are growing worldwide, think again, because this is not the case. As the Fed continues to increase interest rates, China, on the other hand, has been lowering it. What does this mean for us? With the Federal Reserve increasing interest rates, China's economy could potentially crash. Now, China represents a major part of our economy, and if it goes into a recession, the United States will be affected as well. The problem lies with the fact that China is under major deleveraging. The term refers to the point at which a firm tries to cut down its financial leverage or its debt. As this is currently happening, China still has to battle Omicron because the country's government has been strict on lockdowns. These two factors have been the culprit to China's slow economic growth. As Chamath says, the rise in inflation is not of runaway inflation anymore. So this weekend, China cut interest rates. Now, as we know, we are dealing in the United States with the issue of whether we should raise rates and by how much, because we're worried about inflation. Well, if you're cutting rates, it's because you're worried about the other problem, which is that the economy is basically turned over and you need to become more accommodating. Back in 2018, everybody was worried about what the Fed was going to do on interest rates. The Fed was looking at China as the canary in the coal mine, the leading indicator of what we should do. By the end of 2018, Jerome Powell, the Federal Research Chairman, decided to raise rates as we enter 2019. However, the Chinese economy slowed down, and here comes the realization that the economy is not as strong as we thought. And so the people's reaction was disproportionate to what the actual data on the ground said. The United States of America suffered a recession in 2019. You probably heard of President Trump blaming Powell for it. The Fed might be too optimistic about the US economy. As the Fed thinks too highly of the country's economy, rate hikes may potentially crash it. Situations like China's already showed us that any strong economy can still turn over. China cut rates. This past weekend, actually, Germany decreased their GDP forecast. And so you're starting to see two huge countries already saying, hey, wait a minute, we need to be more realistic about what long-term growth looks like here, says Chamath last January 2022. He further added, it's inconceivable in my mind that those countries are slowing down and we won't. So I think what happens in these other huge GDP drivers of world GDP will affect us. The marginal risk will be that we overcorrect and actually create a recession that doesn't need to be one. As the Federal Reserve Open Market Committee meeting took place, Jerome Powell had his eyes fixed on raising interest rates and cutting down bond purchases. This action supports Chamath's statement in an impactful manner. When the Fed increases interest rates, a few investors might think that the market bottom is close, but this is not the case. Market prices are forward-looking. As theorized by the efficient market hypothesis, the market is relatively efficient. In the efficient market hypothesis, all asset prices reflect the available information. However, this doesn't always ring true, but is relevant to a certain degree. People are aware that rate hikes are approaching, and this reflects in the market. Chamath warns us that the market actually tends to increase after rate hikes occur. With that in mind, perhaps rate hikes are already being priced in, and it's time to start dollar cost averaging into the market. To cool down inflation, raising interest rates is necessary. However, it has some drastic consequences. Powell's statements have confirmed Chamath's prediction that inflation is indeed going to be transitory. Like the case of China, inflation could quickly decelerate as the economy slows down. Bill Ackman, a well-known hedge fund manager, has been urging the Fed to push interest rates at a much higher scale. This man has a short position in the bond market, and if the Fed heeds his advice, then he would benefit from it. This is a predictable move by Ackman because he's been known for manipulating the market. In March 2020, he told CNBC that the pandemic will continue to bring the whole economy down while cashing out his short position and going long in the market. Chamath says that if we overcorrect, and the leading indicators all around the world tell us that their economies are weak, then inflation may have actually been much more transitory than we thought. And right now, we have to decide, because if we overcorrect, we are going to plunge the United States economy into a recession. The economy can go down into a recession, but this doesn't automatically pave the way to a market crash. The mild recession that America experienced in 2018 led to a 17% decline in the S&P 500. This actually is a small thing. Why? There's a lot of money on the sidelines. Total savings at all depository institutions have increased to over $11 trillion over the past decade. That is a significant amount of money, and a considerable amount of that money is waiting for a buying opportunity. Even if the market crashes as drastically as it did when COVID hit, it would likely bounce back relatively quickly because of the cash waiting to buy the dip. Not only that, but a lot of tech stocks have already crashed by huge amounts. 40% of stocks on the NASDAQ have crashed at least 50% from their highs. That level of depletion is almost equivalent to previous economic disasters. Chamath reassures that even if the market crashes further, it likely won't last long because there's simply too much cash on the sidelines. In the 2018 market correction, the market only fell by around 17%. Nobody knows how large the crash will be, but it could be as small as the 2018 correction. That being said, now that prices are correcting, the dust is settling down and rate increases are being priced in. Market prices are forward-looking, so you might want to get started on dollar cost averaging into the market. The inflection point for the market will happen when inflation cools down, and therefore rate increases will pause, if not revert downwards. But it is impossible to pin down when that exact point takes place. If it does happen, dollar cost averaging might be the key to being safe. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!